All right, let's dive into the new Income Tax Act 2025. A huge change is coming, especially with how we handle asset transfers. We're going to focus on a really critical part, Section 70. This section tells us when a transfer isn't, well, a transfer for tax purposes. Getting this right is a huge deal. It can literally save businesses and individuals from some major tax bills. So let's break down exactly what it all means.
So here's our game plan. First, we'll get a handle on the basic problem, what usually gets taxed as a transfer. Then, we'll jump straight into Section 70 and its specific carve-outs. We'll walk through a real-world example to see how it works, cover the absolutely essential compliance stuff to keep you out of trouble, and then wrap it all up with a quick checklist to make sure it all sticks.
Okay, let's set the stage a bit. When you hear the word transfer in a tax conversation, what's the first thing that pops into your head? Probably capital gains, right? But it's not always that simple. The law is smart enough to know that just because an asset moves from one hand to another, it doesn't automatically mean it was a commercial sale meant to make a profit.
Let's make this real. Imagine a parent company, a holding company, and it's just shifting some assets over to a subsidiary that it owns completely, 100%. Now, on paper, that's a transfer, no doubt. But should it really be taxed? This is the exact kind of situation Section 70 was designed to address. Keep this question in the back of your mind. We're going to find the answer. You see, the starting point, the default rule, is really broad. The Act basically says a transfer is anything from a sale to an exchange to even just giving up your right to an asset. The taxman's net is cast very wide here. Generally, any of these actions can trigger a capital gains tax.
And that's exactly where Section 70 of the new Act steps in. The best way to think about it is as a safe harbor. It essentially carves out specific, named exceptions to that super broad rule. It gives us a list of transactions that, even though they look and feel like transfers, are not going to attract any capital gains tax.
Now, for all of you who've been working with the old 1961 Act, this whole idea probably sounds pretty familiar. And it should. Section 70 isn't some brand new, radical concept. It's really the next generation of the old Section 47. It takes all those same core ideas, but the goal is to streamline and clarify them for the new tax system. Think of it as evolution, not revolution. Okay, Section 70 itself has a pretty long list of these exempt transactions. So to make it all a bit easier to digest, we've grouped them into three main categories: family and personal stuff, big corporate reorganizations, and a few specific capital market transactions.
First up, let's talk about transfers that happen within a family or for personal reasons. The whole idea here is that these kinds of transfers aren't driven by a commercial motive to make a profit, so the law treats them very differently.
The logic is pretty straightforward, right? If you're transferring an asset as a gift, or it's being passed down through a will, or it's part of an HUF petition, that's not a sale. The law sees it as just moving assets around within the family unit, not a taxable event.
Okay, next up is a category that's incredibly important for anyone in the business world: corporate reorganizations. And this is where we're going to find the answer to that question I asked you to keep in mind earlier.
Take a look here. You can see the core rules for things like mergers, demergers, or those holding to subsidiary transfers. You see the pattern? There are always very specific conditions you have to meet. And they're all there to make sure it's a genuine corporate restructuring, not just a sale disguised as one. So, to finally answer our opening question, yes, a transfer from a holding company to its 100% Indian subsidiary is absolutely exempt, but only if these conditions are met to the letter.
And finally, let's quickly look at our third bucket, which covers some specific things you'll run into in the financial markets.
Here again, the goal is to help things run smoothly. You exchange your old shares for new ones during a merger, not a sale. You convert your bonds or debentures into shares, also not treated as a taxable transfer. In fact, the new income tax rules for 2026 give us some very specific guidance on this, all to make sure there's no unnecessary tax friction in the markets.
Theory is one thing, but seeing how this all plays out in practice is where it really starts to click. So let's walk through a simple example of an amalgamation.
Okay, so picture this. We have a company, ABC Limited. It's merging into a bigger Indian company, XYZ Limited. Two separate companies are about to become one.
So here's how it goes down. First, ABC transfers everything, and I mean everything, all assets and liabilities, over to XYZ. Then, XYZ issues its own shares to the shareholders of ABC. Now, here's the key. Assuming they've ticked every single box required by Section 70, like XYZ being an Indian company and that crucial all assets and liabilities rule, the whole transaction gets the green light for exemption.
And this is the magic number. The result? The capital gains tax liability for ABC Limited on this massive transfer of its entire business is zero. Nothing. Zilch. It's a completely tax-neutral event designed specifically to help businesses combine and grow.
Look, knowing the law is half the battle. Complying with it and doing it perfectly is the other half. And getting this wrong can be a very expensive mistake. So let's talk about what you need to do and what you need to avoid.
You can bet the tax department is going to want to see proof. Your documentation has to be airtight. We're talking board resolutions, shareholder approvals, and for those big corporate deals, you need the official, sanctioned scheme from the NCLT. For personal stuff, registered deeds are non-negotiable. There is absolutely no room for shortcuts on the paperwork.
And here's where people often trip up. When the law says all assets and liabilities, it means all. If you leave even one small asset behind, you could lose the entire exemption. Another big one is not paying attention to the rules about shareholding after the merger. Honestly, just overlooking one of these little conditions in the fine print is the fastest way to get into trouble.
All right, we have covered a lot of ground, so let's bring it all home with a final checklist of the key takeaways you really need to remember.
If you walk away with anything today, make it these 4 points. 1. The default position is transfers get taxed. 2. Section 70 is your rulebook for all the exceptions. 3. Every single one of those exceptions comes with strict, non-negotiable conditions. And 4. Your paperwork is your only defense. Get these 4 things right, and you'll be able to navigate Section 70 with confidence.
So I'll just leave you with this one final thought. The real skill in tax planning isn't just knowing that an exemption exists. It's about deeply understanding and meticulously meeting every single condition that comes with it. That, right there, is the thin line between a successful tax-free transaction and a very, very costly mistake.
Thank you so much for watching. If you found this useful, please hit that like button, subscribe, and share it with your colleagues. Just a quick reminder, this is all for educational purposes. Tax laws change, so always consult with a professional advisor for your specific situation.